Welcome back to Explain the Charts, your go-to channel for in-depth technical analysis. Today, on October 12th, 2025, we are dissecting the massive flash crash that has rocked the Bitcoin and broader cryptocurrency markets. The catalyst for this chaos stems from major geopolitical developments. President Donald Trump announced a staggering 100% additional tariff on Chinese goods, set to take effect on November 1st. This was a direct response to China's own announcement of aggressive and unprecedented export controls, also starting November 1st, reigniting fears of a global trade war. The market reaction was immediate and brutal. We saw what some analysts are calling COVID-level nukes, with over $7 billion in liquidations in just a few hours. The total crypto market cap shed nearly $200 billion as panic selling took hold. Bitcoin, which had been trading comfortably above $120,000 and even set a new all-time high near $126,000 on October 7th, plummeted violently. Reports show the price tumbled from around $117,000, crashing below $110,000, with some futures markets seeing wicks as low as $102,000. Now, let's turn to the charts to see what this looks like technically. Here on the daily chart, you can see the incredible bullish momentum we've had since the summer, pushing us to new all-time highs just days ago. But this candle right here for October 10th shows the sheer force of the sell-off. It's a massive red candle with a long lower wick, representing a drop of over 7% on the day, erasing weeks of gains in a single session. The following day, October 11th, saw continued downside, though it managed to close off its lows, suggesting some buyers stepped in. The price broke through several key support levels in its descent, including the psychological $120,000 mark and the $117,900 level, which some analysts noted as a key Fibonacci level. This event has completely shifted the market structure in the short term, turning previous support into new resistance. The primary resistance zone to watch now is that pre-crash area between $117,000 and $121,000. On the downside, the low of the crash on October 10th was $103,310. This has now established a major support zone, roughly between $103,000 and the low from October 11th around $109,600. Holding this zone is absolutely critical for the bulls to prevent a much deeper correction. To get a better sense of the event itself, let's zoom into the 1-hour chart, focusing specifically on the October 10th to 11th timeframe. Here you can see the price was already showing weakness, trending down from $121,700. Then, in this series of candles, the floor completely fell out. The massive increase in volume during these hours confirms this was a high conviction, panic-driven sell-off directly correlated with the tariff news hitting the wires. We saw a drop of thousands of dollars in a single hour. However, what's also interesting is the bounce from the lows. Price did not stay near $103,000 for long, indicating that some buyers saw this as a major discount and an opportunity to enter the market. Following the initial crash, the price has been attempting to stabilize, forming a range mostly between $110,000 and $113,000. Now let's switch to the 15-minute chart to analyze the most recent price action. In the last several hours, we can see a tight consolidation pattern forming. The price is essentially moving sideways, coiling after the immense volatility. This indicates a period of indecision in the market. Traders are waiting to see if the bounce has legs or if this is simply a pause before another move down. The volume has tapered off significantly compared to the crash, which is typical during consolidation. Short-term resistance appears to be forming around the $111,000 to $111,500 area on this time frame. Conversely, short-term support is holding around $109,700. A break above this immediate resistance could signal a push to test the higher $113,000 level. However, a break below this support could mean we are heading back down to retest the lows of the crash. Returning to the daily chart for our summary, let's lay out the scenarios and key levels to watch. This was a classic macro-driven shakeout, a leverage flush as many have called it, which cleared out over-leveraged long positions. From a bullish perspective, this could be a healthy, albeit violent, correction in a larger bull market. The Relative Strength Index, or RSI, on the daily chart has plunged towards oversold territory, a condition from which rebounds often begin. If the broader markets stabilize and institutional ETF inflows, which had paused, resume on Monday, Bitcoin could quickly regain lost ground. A sustained move back above the $117,000 resistance would be a powerful bullish confirmation, likely signaling a continuation of the prior uptrend. Conversely, the bearish case is that this is the start of a new trade war, which will continue to suppress risk assets like Bitcoin. Fear is high and the market structure is damaged. If sellers take control again, a retest of the $103,000 to $108,000 support zone is highly probable. A failure to hold this zone would be very bearish, opening the door to the psychological $100,000 level and potentially even the $80,000 to $90,000 range, which served as major support earlier in the year. In the immediate short term, a period of sideways consolidation between roughly $108,000 and $117,000 seems most likely as the market digests this shock. Let's recap the critical price levels. Major support is now the $103,000 to $109,000 zone. Key resistance is the former support area of $117,000 to $121,000. The most likely near-term outcome, with about a 60% probability, is ranging price action as the market finds its footing. A bullish recovery back above $117,000 has maybe a 40% chance, heavily dependent on positive external factors like rebounding stock markets and strong ETF inflows next week. A bearish breakdown below $103,000 also sits around a 40% probability, which would be reinforced by any escalation in US-China tensions or further panic in traditional markets. Things to watch for are absolutely critical right now. Keep an eye on China's official response to the tariffs, watch Monday's Bitcoin ETF flow data, and pay close attention to the CME futures open on Sunday, as this will give an early indication of institutional sentiment. Finally, I must remind you that this is not financial advice and is for educational and informational purposes only. Trading cryptocurrency is extremely risky, and you should always do your own research before making any investment decisions. That's all for today on Explain the Charts. If you found this analysis helpful, please hit the like button, subscribe, and ring the bell for future updates. Stay safe in these volatile markets.